Welcome to our video where we will answer one of the most burning questions in the financial world today. Is it a good idea to invest in the S&P 500? The S&P 500, known as the stock market's most representative index, has a reputation for providing long-term growth and is often the barometer for the health of the US stock market. However, like any investment, there are risks and rewards. Our goal is to provide a comprehensive overview of the S&P 500 and help you make an informed decision whether to invest or not. The S&P 500, in formal terms, is a market capitalization-weighted index of 500 of the largest publicly traded companies in the U.S. once more than half a century ago, correlating with the rise of the dominant mutual fund company. The idea of indexing proved transformational. The S&P 500 index, launched in 1957 by Standard & Poor's, initially took the form of a portfolio of all of the common stocks of companies found in substantial operation in America. This index had a market value aspect that was related to the essential operating significance of the companies in which it invested. It meant that changes in the index structure, as would take place with new companies entering and other companies leaving the market, would generally reflect changes in the broader U.S. economy. The idea would be to reflect likely changes experienced by a passive investor, as one tracked the fortunes of the national economy. The S&P 500's performance has been a general indicator of the health of the U.S. stock market, comparative market stock performance, and each sector of the S&P 500 can be used as a benchmark for various industries. It is not surprising, then, that the S&P 500 frequently becomes one of the first financial measurements that even non-investors turn to during a time of significant economic change or turmoil. Various factors set the S&P 500 apart from other indexes. One is that it includes only U.S.-based companies, in contrast to the Dow Jones Industrial Average, which includes foreign firms but also whose count doesn't equal 200 despite what the name suggests. Therefore, the S&P 500 can provide a more accurate view of domestic economic conditions. The S&P 500 carries weight not only in the U.S. but worldwide. S&P 500 stocks are some of the most dynamic in America. They're constantly revolutionizing, which makes them fertile ground for your investing aspirations. The S&P 500 is reflective of every major industry and sector in the U.S. economy. It's an expansive list of companies, and they're a part of your everyday life. From household technological devices to the food you eat, clothing you wear, or even your next flight holiday. Over long periods, the S&P 500 generates even better returns than many investment professionals, research shows. The common stock market itself has been a general generator of wealth over time, and so the S&P 500 broadly has been a participant in that wealth creation. The S&P 500's size advantage allows it to influence market trends significantly. It has attracted trillions of dollars in assets, enabling it to engage in significant trading transactions. The index's broad diversification means that it is never dependent on a few stocks to perform well. Its 500 constituents span a wide range of industries and sectors, thereby minimizing the impact of a downturn in one sector. Passive investment products, like index funds or exchange-traded funds that track a market index like the S&P 500, have grown in popularity in recent years. These products have also revolutionized individual investing. They offer significantly lower fees than actively managed mutual funds, which have to employ analysts and portfolio managers to actively select and monitor stocks, and potentially higher after-fee returns when you take a long-term view. Diversification is critical to reducing risk for most investors. The S&P 500, which encompasses a broad array of companies across several industries, provides this diversification. If some companies perform poorly, others may perform well. Moreover, because the S&P 500 typically reacts at least somewhat to changes in the broader market, investors therein essentially dovetail their positions with the market as a whole. The S&P 500 is used as a baseline by investors and analysts for multiple purposes. Looking at S&P 500 returns over the history of the index, the argument for investing in the index seems strong. With the compounding benefits, even relatively small differences in average returns can translate into substantial differences in terminal wealth. The reliable data on performance is one reason so many investors, from small investors to pension funds and other massive institutions, benchmark their returns against the S&P 500. It's a crucial determinant of professional investment performance. Investing in the S&P 500 provides a buffer against individual company risk and leverages economies of scale. Historically, the S&P 500 has returned around 10% per annum, above other popular indices such as the Dow Jones Industrial Average and the Nasdaq. During times of market growth, it may even have the potential to outperform many actively managed funds. Would you like to invest in it? Well, it depends. As with any investment, individual results will vary. We caution investors from seeing the S&P 500 as a sure thing or a guaranteed return investment. There are periods when the S&P 500 performs poorly, which may last for several years. Investors need to be able to tolerate short-term volatility to benefit from the long-term growth potential. As a buy and hold investment, the S&P 500 is an excellent choice for passive investors who want to minimize costs and enjoy 500 company stock ownership on the cheap, but also active investors who want to use it as a core for building opportunistic sector-specific portfolios. It's easy to invest in the SPDR S&P 500 ETF, which is a popular exchange-traded fund, or any of the other funds that track the S&P 500. Not every investment can provide such a broad exposure to the entire U.S. stock market. The S&P 500 can give your portfolio a solid foundation. Owning a slice of America has many advantages. In summary, the S&P 500 can be an excellent addition to any investor's portfolio, but it's not without its drawbacks and risks. Before investing in the S&P 500, it is important to understand the potential downsides. These include lower opportunities for significant profit over short time frames, lack of protection from inflation, and possible tax inefficiencies. Additionally, investing in a single index doesn't usually let you participate in new trends or get exposure to attractive individual companies that are not part of the index. The S&P 500 represents a significant portion of the U.S. economy, but not all of it. The 500 companies it includes may be giants, but they don't operate in a vacuum. Other companies, not in the S&P 500, may provide even better investment opportunities. That's where active management comes in. A skilled, knowledgeable manager can often seize missed opportunities and help steer your portfolio clear of weaker stocks. Another key challenge with the S&P 500 can be its high concentration of stocks. The market cap weighting of the S&P 500 can lead to a proportionally significant portion of the index being dominated by a small number of megacap stocks. As of November 2021, the 5 largest companies by market cap, Apple, Microsoft, Amazon, Meta, and Google's parent Alphabet, comprising nearly 25% of the entire S&P 500, and the top 10 about 40%. The stock market, including the S&P 500, can and does experience periods of significant decline. In bear markets, the value of the S&P 500 can fall significantly. Given the possibility of a downturn, it is important that investors have the appropriate risk tolerance, a sufficiently long investment time horizon, and reasonable expectations for the S&P 500's performance. It is essential to invest in the S&P 500 through a diverse and well-balanced portfolio. A broad approach may include investing in mid-cap or small-cap stocks, foreign stocks, bonds, and other asset types. By combining the S&P 500 with a variety of investments, you can smooth out your portfolio's overall volatility and create potential opportunities for increased earnings over the long run. So, is it a good idea to invest in the S&P 500? Overall, the S&P 500 is a strong long-term investment choice for many investors. Investing in the S&P 500 can be a great way for investors to gain broad exposure to the U.S. stock market. The S&P 500 has historically performed well and outperformed many of its rivals. Yet, investing in the S&P 500 may not be the appropriate choice for every investor. Some individuals may prefer a more targeted investment strategy that focuses on specific market sectors, or that provides exposure to specific types of stocks or investments. It is important for each investor to evaluate their own investment strategies, objectives, risk tolerance, and financial situation. The important thing is that all investments carry risk. The S&P 500 is no exception. While the stock market tends to increase in value over time, it can also experience significant declines. Therefore, anyone investing in the S&P 500 or any other investment should be willing to accept a certain level of investment risk, particularly in the short term. One can invest in the S&P 500 through a mixture of mutual funds, exchange-traded funds, ETFs, and individual stocks. Each allows for a different level of control and involvement in the investment process. Understanding these differences can help a potential investor choose the right approach based on their individual situation and investing preferences. In summary, investing in the S&P 500 is not a guaranteed path to wealth, but it has historically provided strong long-term returns. Many investors choose to allocate a portion of their portfolio to the S&P 500 in order to gain broad exposure to the U.S. stock market. However, investors are encouraged to consider their investment goals and risk tolerance before making any investment decisions. Finally, do understand that the imbalances, dislocations, and changes that can emerge in the realm of stocks are the lifeblood of the market. They present opportunities for individual investors, provided they take the time to understand them. Ultimately, the best way to achieve long-term financial success is to find ways to make the market work for you. Thank you for joining us as we explored the question, is it a good idea to invest in the S&P 500? We hope this video was helpful in illuminating some of the pros, cons, and associated risks with such an investment. Remember, there is no one-size-fits-all solution to investing, and doing your due diligence is the key to making the right decision for you. As always, we would like to re-emphasize that investing always collateralizes with risk. In the stock market, these risks could result in a loss of the principal investment. Investors are encouraged to review and assess their risk tolerance, investment objectives, and ensure their investment decisions comply with their financial objectives. Remember, although the S&P 500 has performed well historically, it is possible that circumstances in the future could result in the index no longer performing as well. It is important to remember that past performance is not indicative of future results. Therefore, before deciding to invest in the S&P 500, it is important to carefully consider one's financial situation and investment objectives. Be sure to subscribe to our channel for more informative videos on investing and personal finance. If you'd like to learn more about specific aspects of the S&P 500 that we didn't cover in this video, or if you have any questions, don't hesitate to leave them in the comments section below. We'll be happy to help. Always remember the fundamental advice: pay off your debts, stock your emergency fund, and then consider the S&P 500 or other investment options. Always take the time to do your own research and make decisions that are right for you. If you're unsure about your investment choices, seek advice from a financial professional. The S&P 500 can offer a return that, over long periods, outperforms other investment options, though virtually all forms of investing are characterized by some degree of risk. As a result, it's important to consider these risks while factoring in your investment goals when deciding whether the S&P 500 and its ETFs and mutual funds are an appropriate investment for you. Thank you for watching our video about whether it is a good idea to invest in the S&P 500. We have found this discussion insightful and hope that you have, too. Always remember, no investment is without some degree of risk, and it's important to consult with financial professionals and/or perform your research before investing in any market that may carry risk.